when I made my mind to step into the world of investment. The hardest part was to decide where I should invest and how I can keep my money safe and get the better returns in the future. Then I decided to dig about it. Nowadays, there are numerous platforms available which even made me more confused and overwhelmed. Today, if you hear the word investment, probably the first thing that comes in your mind is like stocks. In fact, there are two different markets, capital market and money market. Don't get yourself confused. In this video, I will explain you the difference between money market and capital market. Let's get into this. My name is Prabjot and in 2021 my mission is to help 1000 people to start investing. So turn on your notification not to miss the next video. What is the most important and the basic difference between the stock market and the money market? The biggest difference between the money market and stock market is money market is for short term, usually for 1 year or less, and stock market is for the long term investment. Money market is very safe game to play if you want your principal with an extra little income. But if you are bold enough to take the risk, then stock market is your place to put your money. Money market is short-term loans to the bank and the corporation on which they pay the interest on the principal amount at the maturity age and allowing the borrowers to operate their day-to-day operations smoothly. So how does it work? Large companies with less cash flow need can borrow from the dealer. Small companies can invest via money market, mutual funds, and individuals can invest into money market accounts, which is called MMA. So the next question you might have is like, what are the different types of securities you can give to the bank? Treasury bill, certificate of deposit, commercial paper, banker's acceptance, repurchased agreement. Stock market. Investing into the stock is like watching a flower to bloom. Buying the stock gives the shareholder a partial ownership of the company. Let's say an Apple decided to launch their new iPhone. They will advise their product. If you buy the Apple stock, you will become the shareholder in their company. As the demand for the new iPhone increases, the stock will also increase. As a result, the price of the stock will also increase. It will also increase the profit of the stockholder. This boost in the stock will also raise value of the company in the market. However, this gain is not permanent and the reverse could also happen. If for any reason the stockholders decided to sell their shares, the price of the stock will decrease as the demand for the product decrease. The price is directly related to the demand. I would say the human confidence has very powerful effect in the market from the economic boom to economic collapse. But the first and the most important thing is to start investing. So turn on your notification not to miss the next video.